Hi guys, today we'll discuss Shopify, a circular winner within the software space, which has tumbled almost 60% from its 52 weeks high price. I think it will be a good time to pick up this long-term winner, and I have a price target on the stock of about $611. Even though this is still slightly higher than the current price, quality growth names such as Shopify generally trade at premium valuations, and I think that this could be a time to start accumulating the stock. With that said, please do your own research. Shopify's investors have taken some heavy losses year to date, with investors losing 50% of their money. Shopify's stock plunged after its latest earnings report this week, which saw Shop reporting revenues ahead of consensus but profitability below. The company also warned of caution ahead due to macro conditions, pointing out slower growth, higher costs as Shop reinvests into growth in 2022. With a risk-off market environment this year, this was perceived to be a negative print to investors. That said, this drastic drop represents a strong long-term buying opportunity for a best-in-class e-commerce asset. Shop aims to be a one-stop e-commerce solutions for merchants, offering a full-stack retail operating system that can solve a majority of a merchant's pain points. Besides just marketing, apps, and fulfillment capabilities, it is also fast expanding to fintech, offering payments, lending, and other financial solutions for its expanding merchant space. In terms of revenue, Shopify's revenue has grown at high double digits over the last few years. Subscription solutions refer to revenues from one of the 4 plans that Shopify's merchants can choose from, ranging from the basic plan at $29 per month to Shopify Plus at $2,000 per month, while merchant solutions refer to additional features on the platform. Subscription solutions are tied to increase in number of new merchants joining the platform, while merchant growth is tied to greater use of Shopify's offerings. Clearly, the rapid growth in merchant solutions indicate that the platform is a highly attractive and sticky one to merchants. With that, let's move on to the investment summary for today. Firstly, I think that Shop is well positioned to tap into a long runway for e-commerce growth both in US and globally. Secondly, Shop is a highly sticky platform for the vast majority of retail merchants. And lastly, fintech and fulfillment will be key growth drivers for Shop going forward. With that, the stock also comes with some key risks. Firstly, there will be interest rate risk that is clearly present this year. Secondly, there could be increasing competition from Amazon and other e-commerce solutions providers. Thirdly, the adoption of Shopify's fulfillment network may fail investor expectations. And the last point would be international share gains could be difficult. To value the stock, I've used a DCF approach, arriving at a target price of $611 based on a terminal growth rate of 4% and a WACC of 10.4%, with terminal year EBIT margins to be 20%. The revenue will grow at a CAGR of 33% from 2021 to 2026 and slow down to 17% from 2026 to 2031. One thing I've done differently from brokers is to treat share-based compensation as a real expense instead of a non-cash expense. So with that, let's move on to our first thesis, which is e-commerce growth. Due to Shopify's business model, growth in merchant base is one of the most important KPIs given its highly recurring revenue generation. Shopify saw an explosion in merchant growth in 2020 as COVID accelerated online store creation and migration to new era platforms. But growth has since slowed down to 18% year-on-year in 2021. However, it is a positive sign to see that GMV per Shopify merchant has grown consistently. And while overall GMV growth is likely to slow down, the circular themes driving e-commerce is likely to persist going forward. So what exactly is the opportunity or total addressable market for Shopify? According to research, Shopify's current GMV of $175 billion is around 20% of the expected US e-commerce market for 2022 and only 6% of the global e-commerce market for 2022, excluding China. This indicates that there is still plenty of room to grow long-term. In the past, the entirety of Shopify's merchant services has been concentrated on servicing Shopify merchants, with Shop Pay available as a checkout option only on Shopify's sites themselves. This changed when Shop Pay was expanded to shop merchants on other platforms such as Facebook and Instagram, and the expansion was deepened with a subsequent announcement that Shop Pay would be available to any merchant selling on Google and Facebook. This move will further solidify Shop's leadership as a true multi-channel vendor and continues to simplify the process for a merchant to manage all its sales across various channels. This also allows Shop to tap into a large off-platform merchant solutions total addressable market, allowing gross payment volume to decouple from Shop's online store's GMV and could present a massive upside to the stock. Now let's move on to the high platform stickiness that Shop has. Shop's basic platform prices has been kept low consistently. Entrepreneurs can set up a Shop store for only $29 per month and start selling immediately. Shop's core platform fees starting at $29 per month for small and medium businesses to $2,000 per month for Plus is not only one of the lowest in the industry but also offers the most compelling value. So for companies that are starting out, Shop is the best platform to go to for managing their own technology, as it would be too expensive to do it without Shopify, especially when the business is subscale. And as a whole, Shop's subscription revenues accounts for only less than 1% of its total GMV, which indicates how under-monetized the whole platform is. The platform has also been so sticky and attractive for customers that Shop has experienced increasing cohort spend. Over the last few years, Shop has experienced strong payment solutions, shipping and capital services penetration gains among its merchants. Adoption rates saw a large increase during COVID as merchants in new cohorts opted to use additional solutions at a higher rate than existing merchants. This also shows how Shop is able to deliver on higher expectations and retain merchants as they grow throughout their platform. By dividing Shopify's revenue over its GMV, its take rate is only 3% now, and this is way lower than other e-commerce platforms like Amazon, Melli, Etsy, as well as eBay, according to Deutsche Bank's report. Take rates have room to further expand as the company continues to fulfill its monetization efforts such as fulfillment, marketing, and financial solutions. Now let's move on to the growth initiatives that Shopify have in terms of the next few years. In its latest presentation, Shopify has spelled out its initiatives for the near, medium, and long term, of which there are two notable areas. Firstly, there is its greater fintech offerings in terms of Shopify Capital and Pay installments. And secondly, there is Shopify's fulfillment network. Monitoring the success for these areas will be critical going forward. Shopify Capital is the company's merchant lending arm, which has seen increasing demand from small merchants who are underserved by banks. Given Shopify's visibility within its merchant base, the company can make underwriting decisions quicker, and analysts are expecting this to become a significant profitability driver in future. Shop Pay Installments is a buy now, pay later initiative done in a partnership with Affirm. And while it may not offer significant monetization now, this has been shown to increase customer conversion, increase average order values and basket size, and increase customer satisfaction. Lastly, Shopify is launching its own fulfillment network. This is basically a supply chain management business that relies on 3PL networks. The 3PL network, logistics network in US is a highly fragmented market, and one main pain point is the difficulty of integrating them into an online store. Therefore, Shopify's fulfillment network aims to enable merchants to set up fulfillment in a matter of hours to days. While this is a very strong value proposition for merchants looking for logistics for the first time, the product is seeing limited traction amongst merchants using a competing service because of high switching costs and added complexity. Management has also pointed out that this is still in the works, and this is one area that investors will have to watch out for closely, especially as the management will keep investing aggressively into these growth areas. Now let's move on to key risks for the stock. Data has shown that Shopify has a leading market share when it comes to top e-commerce software. However, it does face competition against other e-commerce solutions, including players like WooCommerce, BigCommerce, Wix, and Squarespace, which all compete in the small to medium businesses space. Upmarket, it also competes with Magneto Commerce and Salesforce when it comes to larger businesses. Therefore, it is critical for Shopify to expand its offerings so that merchants will not leave the ecosystem to pursue an upmarket offering or a standalone solution once it reaches critical size. That being said, I do believe that there is sufficient growth runway in the SMB side for Shopify to compete in. The second key risk I'd like to talk about is Shopify's plans for international market share gains. While their business model is exportable, I saw a meaningful chart in Deutsche Bank's report which stated that the competition landscape internationally is crowded with new Shopify-like players. As Shop gained market share over the last decade in the US, startups across the globe followed Shopify's playbook to offer a compelling e-commerce solution to their own home countries. For example, based in Japan, Baozun in China, and Novem Shop in Latin America all offer e-commerce solutions to compete with Shop. Given each vendor's familiarity with the norms of each home country, Shop could be disadvantaged as they need to achieve product market fit for each market. Now, let's look at the DCF for Shop. Shop's capital structure is light on debt. Assuming a cost of equity of 10.5%, a pre-tax cost of debt of 4%, I arrived at a WACC of 10.4% for the company. For the next 5 years, I'm assuming a slowdown in GMV growth, growing at a CAGR of 25%, which is in line with global e-commerce growth rates. I've assumed that take rates can gradually increase from 2.6% in 2021 to 3.6% in 2026, as the company begins to monetize its offerings. With that, revenue is expected to increase at a CAGR of 33% over the next 5 years. I have then assumed that revenue growth rates will decline over a straight line to around 10% year-on-year by 2031. EBIT margins, which deducts share-based compensation, is projected to increase from 8.3% in 2021 to 20% by 2031 as the company achieves operating leverage. For CAPEX, the company said that they will invest around $200 million next year, representing around 3% of projected revenue. But I think that with Shop's business model, CAPEX as a percentage of revenue will decrease gradually as the company moves past its heavy investment stage. Past 2031, I've used a simple percentage growth method to project unlevered free cash flow to reach terminal value, with decreasing growth rates till 2036. With mid-year discounting, this gives me a value per share of $611. I've also constructed a sensitivity table of WACC against terminal growth rate, with scenarios of $500 to $700 in terms of target price. And with that, I think I've come to the end of today's video, and if there are any more interesting stock recommendations, please leave them in the comment section below, and I'll see you on the next video.